What are some red flags that founders should look for when they're raising capital from investors?
So raising capital is this weird kind of dynamic where it sometimes feels like you are the product that some and or that investors are somehow being nice to you by giving you money. And this dynamic is played on by unscrupulous investors in really quite um, frustrating and despicable ways. So when you're going through any kind of funding round, you need to be very careful of what types of rights that you're giving away to these investors, and also what is motivating the investors who are investing into your company. I think some of the red flags that investors um, sometimes ask for, or some of the red flags that founders should look for when speaking to investors are: what kind of follow-on rights do they have? What kind of liquidation preference rights do they have? We can get into
Mm.
to some of this later. Basically, what happens when stuff doesn't go right or doesn't go well?
Mm.
What kind of rights do they have in terms of selling their shares to other entities? Um, like most things, the fact of these existing is not necessarily a red flag. The intention behind and the way in which someone wishes to use these tools does matter. And I've seen quite a few businesses get completely bent out of shape, in to put it mildly, to utterly destroyed just because of very bad terms that founders didn't understand when they were signing on to them.
Can you shed some light on exactly how VC funds work?
So VCs are technically they are funds. So they are a group of LPs, limited partners, that come together. They pool their money and they have an entity, and the fund is managed by fund managers. Those managers then are deciding where to invest this money. And in ways that might get them different levels of return. So on the top level, that makes sense, right? Then when you split through, there are a whole bunch of different types of VCs. But I think what a lot of people think of when they think of VCs, they're thinking of like VCs that like to be associated with power venture. And power venture means that you need that 10x, 100x type return. So I'll just talk about what those are specifically, because I think a lot of people need to maybe misunderstand in terms of what their motivation is. A lot of people think, why does an investor want to throw 5 million at something with no revenue, no nothing? And then if it doesn't work, they're like, oh, well, that's fine. Like, surely that doesn't happen. And it does happen, and it happens. And the mentality as to why an investor thinks that way, and is quite happy to say, well, maybe not quite happy, but like is fine washing their hands of investment if it doesn't work, as long as it's quick, is in terms of how they work. So let's just say you have $100 million fund. Your LPs are putting this in. It's the highest risk class for them, right? So your LPs are either high net worths, or they're institutionals, maybe they're pension funds, maybe they're governments, maybe whatever they are, and they're putting their money in a whole bunch of different things. And just like they could put their money in Amazon, they also can put a chunk of their money in you, and that's a high risk endeavor. But that means that the returns that you want to offer are pretty high. So there's this term called an IRR, an internal rate of return. And basically, it's a stand-in for how well the portfolio is doing when you don't have access to like public markets. Because if I'm investing in Ryan Corp, it's probably not the case that Ryan Corp is a publicly traded company. So I don't know actually how much is it valued, how much money is there. Um, but I still want to put some money in, and I want it to skyrocket in value. So even at least on paper, the stake that I have for my LPs is rising, and rising quite a bit. But a good IRR, a good internal rate of return, is, let's say, or like a decent one, is about 30%. And what that means, that 30% might not feel super high, but that means every single year. it's growing at 30%. So that works out. If you have $100 million fund and you want a 30% IRR, usually funds last for about 7 or 8 years. That means you as a fund need to turn that 100 million into 825 million. That's a lot of money that needs to be made in a relatively short amount of time. So if you have $100 million fund, that is you just returning like 5 times your investment, 3 times your investment. If you as an individual are like, hey, I'm going to invest in something and I'm going to get 3 times my money back, you're like, oh, that's great. That's great. We've tripled in size. For a VC, that's not great. That's not hitting it. That's not going towards that 30% IRR. So that's why when a VC is looking at companies, their percentages are really in their heads. Can this investment, is there a way in which this investment can return our entire fund? Like, is that even possible? And so when you're hearing about people saying, well, how can you get to a unicorn status, in terms of your company's valued at $1 billion? It's not just a flippant indicator. It's not just saying, oh, we want it to be massive and balls to the wall and, go nuts. There's actually some thought behind it. So if your business, for example, if you're building a business and you're like, we could totally make this into a $50 million business. That is an incredible number. Like, that is an incredible value. That might be incredibly profitable, might be great. It might also be completely wrong for a VC, because so the two aren't the same. I think a lot of people conflate a company is a great company because VCs pump in a whole bunch of money. That's almost the opposite. Like, real companies that are growing really well and are profitable and are delivering returns or dividends are not of interest to VCs, because the part of the market, the part of the risk market that they have, actually they don't have time for good companies. And solid companies in that context, which I think a lot of people might be listening to. If you're listening and you have like a bootstrap company, you're making good money, and you're growing 10% every year, whatever it is, and you see that is a good thing. There are so many other ways that you could then finance expansion or growth or risk than going to a VC. And I think that if though you should be only going to a VC if you have a massive market, if it costs a lot to access that market, right? And the thing that you're doing is eminently like scalable, and you have to do it very fast. Those 3 things, I think, mean that you are then in the sweet spot for VC. Because if you aren't catching fire within a year, even if it's taken a few million to see if you've caught that fire, it is far more efficient for a VC to then say cut losses and go and focus on any of these other bets that they've been putting on that do look like they're catching fire. And that's why a good VC should not be angry, upset, predatory if what you're working on doesn't work out. And I think that's why a lot of founders get confused by it, because they're seeing big numbers and these are big numbers for them, but for the VC, just it's not. And it's not that they don't care about money. They do. They absolutely do. But it's the time pressure is just as precious, if not more important, for them in their journey towards trying to get to a 30% IRR.
Hey, it's Ryan here. If you liked that video, please click the like and subscribe button somewhere down there and check out the full interview right over here. Go on, click it. You know you want to.